Thank you for tuning in to the Starkey Multifamily podcast. I have with me Glenn Mueller. Glenn is widely renowned as an expert in market cycle analysis. Glenn, thank you for joining me today. How are you?
Good. Thank you for having me.
So Glenn, tell us real quick before we get started, tell us a little bit about yourself.
Okay. I have been in the real estate business for 44 years as a bank loan underwriter, as a builder and a developer, then got my PhD in real estate, taught for 4 years, worked at a couple of institutional investors, actually still doing that now since 1990, and back in academics as well. So I've had 2 jobs for the past 26 years. Started my market cycle research work in 1992, and also specialize in analyzing real estate investment trusts.
And I'd like to go over with everybody kind of how it goes from one point of the cycle to the rest, and what factors are influencing that.
Sure.
Can you?
So this cycle chart, as you can see, is broken into 4 quadrants: a recover, expansion, hypersupply, and recession phase, very similar to the economic cycle of the United States. And it has a total of 17 points on it. Historically, real estate cycles have run about 17 years. And if you go to NAREIT's website, that's the National Association of Real Estate Investment Trusts website, that's REIT.com. They have a graphic showing the last 2 17-year cycles, and the fact that we're in year now 10 and a half of the 3rd cycle. So what happens is it's basically just an occupancy cycle. It's vacancy upside down. My analysis runs by looking at the demand for real estate in individual markets. So metro area by metro area. Every metro area is different. It has a different industry that drives its growth. We call them economic-based industries. And different supply. So the amount of supply in Boston is probably going to be different from New York. And the base industries in those 2 cities, while Boston has financial like New York, Boston has other things going on as well. So each city is driven by its demand growth and the supply response to that demand. And every one of the major property types is also different. So when occupancies are low, at their lowest in the cycle, they're at 0.1. When they're the highest, they're in 0.11. And so at the bottom, when you've got too much of any product, what do? You drop the rents. So that happens at points 1, 2, and 3. As we move towards a long-term occupancy average, which is taking a full cycle of 16 years and averaging the occupancy rates, that dotted line. And you can see it goes through that average on the way up and the way down at 0.6 and 14. You get kind of inflation rent growth. Above that, in the expansion phase, you get higher than inflation rent growth, which is where the real sweet spot is for real estate, with rents, occupancies going up and rents rising. And the combination of occupancies and rents drives income for real estate. We don't talk at all about, in my cycles, what's going on with property prices. That's a different cycle we can talk about later. And 0.8 on the cycle is green because that's where we get cost feasible rents, i.e. that's when it's feasible to start building new projects. And by that, I mean if it costs $400 a square foot to build a new office building in Denver and investors need a 10% rate of return, that means 10% of 400 is rents have to be $40 to cost justify building that new building. And above that, demand's growing, supply is trying to catch up, so you get really high rent growth, well above inflation. And then when you hit the peak, rent growth is still positive, but decelerates or slows down at points 12 and 13, kind of back to inflation at 0.14, and then lower negative at 0.15.
So a lot of this is deemed by, so you're measuring on the demand and supply, based on the long-term average. So what's happening, I don't know if can you see my pointer on your screen?
Yes.
So, we've got your growth is coming here where your demand is more than your supply, and you're catching up to your occupancy or long-term average here,
right?
correct?
Demand is above supply from points 1 all the way to point 11.
Right.
When
Okay.
demand's higher than supply, occupancies rise. When supply is higher than demand, occupancy falls. That would be points 12, 13, 14, 15, and 16.
And what causes the kind of equilibrium to kind of come to a peak is when they're able to afford to make new construction here at 8, correct?
Yeah.
And then they start building them, but it still goes up because we've got, it takes time to construct these buildings and put them into place. And then we kind of get to an equilibrium point. How are you measuring the demand compared to the supply? So the supply is pretty easy to measure because you can see what's being built. What are you looking at?
Demand is the amount of space being rented, basically absorption. And supply is the amount of new construction being put in place. Okay. So if demand growth is running 2% for the year and supply growth is running 2% for the year, your old Econ 101 class calls that equilibrium.
Got it. And then so after we start getting a little bit more supply hitting the market, we're starting to outpace the demand, and then that brings it down.
Right.
Those are still going to be hitting the market right up to about 16, right? Or even into 1.
Right.
So they're not building.
They may not be starting something, but they might be finishing an office building that took 4 years to build in a downtown, as an example.
Yep.
Or right now we've got good demand for apartments with millennials coming out of school, but we're building a little bit too much. So it could be demand decline because of a recession, or it could be an oversupply, one or the other.
Now, I've noticed on some of your charts, they tend to move back and forth sometimes. So what is bringing them from a 12 back to an 11, or vice
extra
versa?
Demand that comes on the market, or some supply that got delayed in being finished. So again, it's the connection of looking at the demand and supply numbers and forecasting what's going to happen to occupancy. If occupancy starts to go down, obviously we've either got hyper supply or declining demand, one of the two.
And what do you know what drives? So what factors are you looking at that drive the demand?
Again, we look at the economic base industries that drive a city. So in Detroit, it used to be purely the auto industry. If the auto industry did well, they added jobs and increased demand for office, for industrial. And those extra working people created more demand for retail and apartment. And as an example, if you want to, actually we can talk about that if you go to one of my slides. For instance, if we look at the slide on office cycles, you notice that Houston, Texas is well over the top, whereas most of the markets are in the growth phase, in the green phase 2. Houston's over the top because of a slowdown in demand, because the industry driving Houston, Texas is the oil industry. And with the low gas prices, they've been laying people off.
Okay. Then at what point, so we've got, our listeners are looking at the apartment. So if I scroll back down to that.
Yeah. So in apartments, what we have is we basically have good demand across the country, but what we have is the cities that are at points 12 and 13 in the hypersupply phase are cities where they are overbuilding the market by, on average in the U.S., about 10%. In other words, if we look at Denver as an example, we needed 8,000 new units last year and we built 10,000.
Yeah, so that can clearly have a negative effect. So maybe a couple questions. Why, so the people in developing new apartments, are they not looking into that and saying, hey, we're starting to get a little bit towards the end of the cycle and we're not going to be able to produce this building for another, 9-10 months. So are they making those decisions, or so why doesn't it slow down when they see that peak and they continue building?
Because they can get their financing.
Okay.
And let's be honest, if I build a brand new building and occupancies are dropping a little bit, all I have to do is drop my rent level to that of older buildings in the market, and I steal people from older buildings to my new building for the same rent. So older buildings get hurt more than new buildings during an overbuilding phase.
So you're saying like the Class C type buildings would be the biggest risk then?
Well, mostly C people probably don't have the wherewithal to do that, but new A building is going to steal from a B building.
So being that, looking at the apartments and being that we're all kind of right at the equilibrium or past it, what does that mean for the buyers and sellers? Should we be concerned about buying now? Should we try to sell what we have now? Or
Well, you should look at the market, and you still have demand growth, but you got a little too much supply growth. So when you're doing your model on, I'm about to buy this building and what kind of rent growth should I expect, the amount that you put in for your rent growth should probably be a little, say, I'm going to be able to get 3, 4, 5% every year for the next 10 years. In my discounted cash flow analysis, you go, maybe it's only going to be 1 or 2%.
Yeah. And that's very, very good point. I see a lot of people underwriting at very aggressive rent growth, and I don't know that I agree with them. But so now some of these, so let's say you mentioned Detroit earlier, and I happen to be in the Detroit market. So if you're looking at Detroit, many of the submarkets are going to be quite significantly different. Still in the same MSA. If somebody was going to kind of draw their own chart, where do you think they would start at? So just looking at would they be able to write their own chart and put it together?
From the first slide we looked at, as I said, markets go through cycles about every 16 years. So if you can go back and get, what you're probably looking for is vacancy information, and occupancy is the inverse of vacancy. So if it's a 9% vacancy rate, that's a 91% occupancy rate. Mm-hmm. So if you can get 16 years worth of data, you can graph out what the last cycle has looked like and figure out where your market currently is in the cycle.
Now, how much bearing do you put? So if we're in a sub-market that's maybe 30 minutes from whatever major market you're looking at, how much bearing are you putting on that major market as opposed to just digging down into the smaller, or are you digging down into the smaller at all?
Okay, so this research work that I do is on the metro markets overall, so that the institutional investors I work with can target what markets to go after. Every market has anywhere from 5 to 20 submarkets. So if you took 54 times 5 or times 20, I would be modeling thousands, tens of thousands of submarkets. Mm-hmm. So when we go to, once we've found markets we like, then we start looking at the different submarkets and run a separate model on them. But I don't do that all the time, because that would be a lot of work for no reason if we're not interested in a market.
Yeah, so you're finding the deal that you're interested in first and then analyzing that submarket and putting it all together.
That is correct.
Fantastic. Well, you covered that whole cycle. That's really what I wanted to get across today and kind of go through the start to finish. So I definitely appreciate that. Is there anything you have to add to that we didn't cover?
Sure. What I don't produce research on, or I don't publish research on, is the other part of the cycle, which is the financial cycle, which is the prices of real estate. All this does is talk about occupancies and rents that drive the income side. The financial side is where capital flow, money coming into real estate, makes prices go up. Money being pulled out of real estate makes prices go down, just like the stock market. So when everybody believes the economy is going to do well and they're willing to take risk, they dump their money into stocks and the stock market goes up. When they're concerned that something's going to happen, they pull their money out, move it over to bonds. Bond prices go up and bond yields go down. And the same thing happens with real estate. So today we have, real estate as the third asset class against stocks and bonds. And we've got an all-time high in the stock market with a dividend yield on the S&P 500 of 1.2%. We've got an all-time high price in the bond market with the 10-year treasury rate, which all your subscribers should be watching all the time, because that is known as the risk-free rate benchmark that we all look at. So look at the 10-year treasury rate. You can actually get it on your phone from the Federal Reserve. I mean, I get a weekly email that says the rate is this, and it moves. You know, it's an open market number that moves every day. But today I think it's running about 1.7, 1.8%. So if you were going to go get a loan from a bank on an apartment building, it's typically going to be a 10-year loan, and it's going to be 2% over the 10-year treasury. So you'd be talking a 3.8 if you're, a high credit tenant with a new Class A apartment building. So watch that rate and what's going on. Real estate today, the spread over the 10-year treasury, in other words, you're investing in an apartment building, getting a higher yield, a higher cap rate than the 10-year treasury because of that extra risk of real estate. And that spread today is running in the neighborhood of, in apartments, it's running probably 3% higher. And in hotels, it's running 5% higher. So it's think about that. And when you start to, so everybody goes, what's happening to cap rates? Everybody says if interest rates go up, cap rates will go up with it. If you look back historically, and studies have been done and shown that that is not true. Correlation between interest rates and cap rates isn't that strong. As interest rates go up, that means the economy is really expanding, which means there's more jobs and more demand and more inflation. So rents go up, and rents typically go up at a faster rate than interest rates. Hence, that cap rate spread stays relatively the same. And all the information I'm reading right now from other researchers, they're all believing that there's so much demand out there seeking yield that more money is going to flow into real estate. And so cap rates are going to stay where they are or even come down a little bit again this year, which for most people seems hard to believe.
It does, yeah.
But the 10-year treasury hit 15% in 1981, and today it's below 2. The last time it was below 2 was 1953. So, and every year for the last decade, every economist has been projecting 4% 10-year treasury 2 years later, and they've been wrong every year for the last 10 years. So I would say that if you find a good building that you plan to keep for a long time, don't expect that you're going to get a correction in the next year or even 2 where you can buy it at a cheaper price. Also, if interest rates do go up, your mortgage is going to go, the mortgage interest rate you're going to pay is going to go up anyway. So right now, the spread between your borrowing rate and the cap rate you're going to pay is still good. And so I still think it's time to buy.
Well, that's excellent advice. So one question, you mentioned, the importance of the treasury rate. And I know a lot of people talk about the yield curve inversion. So what are your thoughts on that, and how does it apply to anything?
The yield curve thing has been right maybe 50% of the time, and that's been over the past 40 or 50 years, but it's been over 60 since we've been in a low interest rate environment. And right now, I don't think the yield curve thing means anything. There's a lot of other, everybody tries to look at lots of macroeconomic factors and say, oh, this one's driving this and this one's driving that. And the answer is no. It's always combinations. And we don't know what those combinations, correct combinations may be, going forward.
Well, if anybody does, it would be you. So if you don't know, then nobody knows. So, well, I appreciate the time. I know we got to kind of get it wrapped up here shortly, but I really want to thank you for coming on. I think that was extremely informative, and I certainly enjoyed having you on here.
Great. Thank you very much. I appreciate it.
I appreciate it. Have a wonderful day.
All right. Take care.